It's still the number one concern on our clients' minds, and it seems to be on investors' minds as well, as the markets remain jittery over inflation worries. How bad is it, and how bad could it get? On today's Fastest 4 Minutes in Finance. Hello again, I'm Scott Inman. Well, you may remember we discussed inflation on the Fastest 4 7 weeks ago. At that time, we told you that LPL Research was targeting a core inflation rate of 3% for 2021, and that would be right around the all-time U.S. average from 1914 to now. Well, last week, core inflation, now that's taking out food and energy prices, came in at 3% year over year. So it doesn't seem like that's runaway inflation. What's going on here? Why are the markets on edge? Well, first, the spike came in a little ahead of schedule. LPL Research expected the spike to happen more into the summer, so if it's happening now, ahead of schedule, it must be going to get worse, right? Well, according to LPL Vice President and Equity Strategist Jeff Buckbinder, you have to take the year-over-year number with a dose of perspective. He points out that the economic shutdown was in full swing last spring, creating a sudden deflation event. So the comparison here is inflation now compared to inflation then. So that makes the increase look perhaps bigger than it is. However, the month-to-month comparisons also revealed inflation spikes not seen in decades. If that continues, there will clearly be a problem with inflation. And that's the question. How sustainable is this surge? Much of the price hikes are associated with supply chain issues. Material cost, production issues, shipping delays have all contributed to a demand that is exceeding supply. As we're opening the economy back up at a torrid pace, we should catch up, right? LPL predicts it will take about 3 to 4 months, but we will, hopefully. And when that happens, it's likely inflation rates will moderate some. Another key factor is a labor shortage. A survey of small businesses found that 44% are struggling to fill job openings. An estimated 1 in 4 Americans are being paid more through government unemployment than they earned while working. And many are choosing to stay at home, and that's creating artificial wage growth. Chipotle is offering to pay workers $15 an hour. Domino's reportedly paying drivers $25 per hour. McDonald's is increasing wages and in some places offering a sign-on bonus, and Amazon doing the same, offering a $1,000 sign-on bonus. Labor is a company's biggest cost, and it's likely to be passed on from business to consumer. The government checks are scheduled to end in September, so we'll see if that moderates as well. It is also worth pointing out, though, that most economists agree the economy is booming. GDP growth estimates are predicted to be anywhere from 6% to double digits. GDP growth like that is almost always accompanied by some increase in prices. Bottom line here is some inflation is happening and is okay. Runaway inflation isn't. We still don't know which we have brewing. But if supply chains and labor markets normalize over the next few months, there's a good chance so will inflation. Thanks for watching.